Good morning and welcome to the Global Financial Leaders Investment Summit. Today we are having conversations with global investors, and that means you today here at our event, jointly organized by the Hong Kong Monetary Authority and the Hong Kong Academy of Finance. Now, Hong Kong, as a world-leading global financial center, is constantly in dialogue with global investors and regulators around the world and the facilitators that power global finance. And that conversation has never been more necessary than now. Right now, we face a time of rising inflation, of high interest rates, a time of high and rising government debts and other storm clouds on the horizon. But it is also a time with greater focus on financial inclusion, on ESG, on exciting new fintech, changing how we do business, and even evolutionary changes to the nature of money itself. To help us to grasp these different developments, we have two fantastic panels today with global asset managers and alternative managers, and they are going to be discussing these developments and giving you a much clearer view on how you can manage risks and how you can seize opportunities. To open today's proceedings, we would like to welcome a fellow of the Hong Kong Academy of Finance, who is also the chairman of the Hong Kong Exchanges and Clearing. For decades, she has lent her quiet wisdom to the highest level bodies in government, universities, and financial bodies in Hong Kong and in mainland China. Ladies and gentlemen, today we welcome the chairman of the Hong Kong Exchanges and Clearing, Mrs. Laura Cha.
Financial Secretary Eddie, distinguished guests, ladies and gentlemen. On behalf of HKEX, I wish you all a very warm welcome to our Connect Hall. Today's event is jointly sponsored by the HKMA and the Hong Kong Academy of Finance as the concluding session of the very successful Global Financial Leaders Investment Summit, which took place last 2 days. I'm sure you will all agree that the dinner at the M+ Museum earlier this week, as well as the very full, outstanding, and impactful sessions that we had yesterday, have all been exhilarating and energizing. Today's session, as a finale, will be just as stimulating. This morning's conversation will focus on creating value during uncertain and challenging times. From where HKEX sits at the heart of Asia's financial markets, we see connectivity as the essential ingredient in building continued resilience, in unleashing the opportunity across the region, and in navigating the inevitable challenges ahead. It is our belief that it is only through connectivity that we will deliver a shared, sustainable, and successful future. We see it in all industries, markets, and economies. Connectivity is essential. We hear it in our conversations, be those with government officials, companies, entrepreneurs, investors, innovators, in any context that we come into. Connectivity is essential. We hear regionalization these days instead of globalization, but regionalization cannot exist by its own in isolation. Regions still need to be connected. The world has always needed and will always need connectivity. And in a fragmented world, we need connectivity more than ever. Hong Kong has always been a super connector. Connectivity is what defines our city as an international financial center. Our role as an East-West super connector is unrivaled anywhere. The global headwinds that will be discussed here today are reminders of the important role that Hong Kong and Hong Kong EX have played in a world that is buffeted by geopolitical tensions, macroeconomic turbulence and uncertainty, and climate change, and more. Recent announcement by the China Security Regulatory Commission on enhancement to the Connect scheme that we have indicate again the importance of Hong Kong as a connectivity region to end to the global success. At HKEX, we see great opportunities for Hong Kong to support the megatrends that are shaping the global landscape. Megatrends such as China's next phase of economic growth, the global sustainability agenda, the rise of the new economy sector, biotechnology, innovations, and many more. And we are proud to play our part through our role in connecting China with the world, in connecting capital with opportunities, connecting today with tomorrow, and simply, like today, hosting an event where we gathered, connecting all the international financial community. This is what we do best. This is what Hong Kong does best. It is great to be connected, and I would like to thank the HKMA and the Hong Kong Academy of Finance for organizing today's event. I wish all a very successful and enjoyable session, and I look forward to many more opportunities to welcome you to our Connect Hall in the future. Thank you.
Thank you very much, Mrs. Chia, the epitome of a super connector all by herself. We would now like to welcome to the stage the honorary president of the Hong Kong Academy of Finance. Since 2017, he has been responsible with his team, with the entire body of his government, for the main vehicle through which Hong Kong policy is made reality, the budget. The different institutions and government bodies that are responsible for Hong Kong's financial and regulatory environment and even its economic development all fall under his purview. He is the financial secretary of the Hong Kong Special Administrative Region of the People's Republic of China. Please welcome Mr. Paul Chan.
Laura, Eddie, distinguished guests and speakers, ladies and gentlemen, good morning. I'm so glad to see you all after the fruitful panel discussions of the investment summit yesterday. I hope you all feel recharged and energized. Today's discussion, conversations with global investors, will focus on how investors could position themselves to manage risks and capture future opportunities. It just can't be more timely. While I look forward to panelists sharing of their valuable insights in their respective investment areas, I would like to share how Hong Kong has weathered through the risks and volatilities in our financial markets. To set the scene, let us acknowledge that the global economic outlook and the investment environment are extremely challenging to everyone. Supply chain disruptions have failed to ease following the 3-year COVID-19 epidemic, aggravated by geopolitical tensions, particularly those from Russia-Ukraine conflict this year. Inflation in advanced economies has been pushed to levels not seen for decades. Aggressive, prolonged tightening of monetary policies by central banks to curb inflation will further dampen global demand and investment. Hong Kong is an IFC, but we are also a small and open economy. We virtually have no natural resources and rely heavily on external trade and investment. Our economy is highly susceptible to external volatility. Turmoil in markets outside is destined to impact on Hong Kong. At a city level, how do we manage financial market risks brought by a world characterized by high uncertainties and volatility? Central to this is our belief that we must deal with security and development together in a well-coordinated manner. Security and development are two mutually dependent subjects. Financial stability is an integral part of financial security, which is the prerequisite for economic development. Yet economic development provides the best support to security, as it strengthens our ability and capability to fend off challenges and risks. That is why over the past 3 years, we have paid much attention to ensuring our financial stability and security. First, we have established a surveillance system to detect risks in our financial market. Together with financial regulators, we have adopted a cross-market, coordinated, and round-the-clock monitoring mechanism over all sectors of the financial markets. It provides, on a rolling basis, regular and in-depth reports, as well as ad hoc reports of the markets to enable us to detect if risks have been building up. Second, we have stringent capital and other requirements of the regulatees. We regulate and conduct on-site inspections and stress test them on both regular and ad hoc basis to ensure that they have conducted themselves properly and they are resilient, and reports filed by them are accurate and complete. We will act decisively as and when necessary. Third, we maintain strict discipline and build strong buffers in preparation for turbulences. Take our banks as an example. In Hong Kong, the capital adequacy ratio of banks currently stands at about 20%, which is way higher than the international standard of 8%. Their liquidity ratio is around 155%, compared to international standard of 100%. Classified loan ratio is just about 1%. Our banking system had assets of $3.3 trillion as at the end of last year, more than 9 times of our GDP. One aspect of financial stability that critics like to talk about during times of volatility is Hong Kong dollar exchange rate under the linked exchange rate system. Over the years, we keep the exchange rate of Hong Kong dollars at US $1 to Hong Kong 7.75 to 7.85. When the strong or weak side of the band is touched, the Hong Kong Monetary Authority will come in to take or give Hong Kong dollars in accordance with the system design. The consequential increase or decrease in the aggregate balance will trigger interest rate adjustment, and the market will eventually find its equilibrium. As mentioned above, we have built very strong buffers and resilience in the banking system to support this, and we have been exercising strict discipline to keep the capital inflow in liquid US dollar-denominated instruments so that we can pay them back anytime. It is all the more worth mentioning that our foreign currency reserves stands at around $430 billion, equivalent to about 1.7 times of the Hong Kong monetary base. So, if you bet against Hong Kong dollar, you are bound to lose. You can verify my advice with certain hedge fund managers in the US who has been wrong about Hong Kong dollar time and again. As for securities, Hong Kong's stock market is vibrant, active, highly liquid, efficient, and transparent, attracting investors from all over the world. We attach great importance to investor protection as well. We believe that for a market to succeed in the long term, it must be trusted by both market participants and investors. To achieve this, we set clear rules for our markets, stringent requirements on the participants, maintain high transparency of its functioning, ensuring that policies and practices are implemented in a consistent and predictable manner, for they are the cornerstone of international investors' confidence in Hong Kong market, where they can make use for investment and fundraising. The stock market in Hong Kong has been quite volatile recently. There have been calls that the Hong Kong SAR government should do something, for example, about short selling in the market. Let me tell you that on a daily basis, we analyze in depth the performance of our markets. For example, factors causing such volatility is performance vis-à-vis markets in the region and the global markets, the short selling volume and the underlying reasons, who are the players, relationship between short selling and short positions, any concentration risks. We also look at the futures market as well as the derivatives market. We also analyze the information in the trade repository system. Basically, so far, there was no cause for alarm. We also look at the clearinghouse, licensed corporations, and the mutual funds to ensure that they are financially sound and resilient. In short, amid market volatility, we focus on whether the markets are functioning orderly and properly, and whether there are systematic risks, irregularities, and vulnerabilities that will threaten Hong Kong's financial stability. Ladies and gentlemen, I hope my sharing on our philosophy and approach towards market regulation has facilitated better understanding and inspire more trust in our system and our markets. Hong Kong is an IFC with an internationally aligned regulatory regime, deep liquidity, great transparency, and much resilience. With proper safeguards to protect investors, we are simply the best IFC in Asia. You are most welcome to do business and make more investments here. I wish you all good health and the best of business in the coming year. Thank you.
Thank you. Thank you very much, Mr. Financial Secretary. We know that you moved heaven and very sandy earth to be here with us this week, and we do appreciate it. Thank you again. Thank you. You, Mr. Secretary, you've had to deal with volatility as we all have done in our business, and the mandate of our next panel is to determine how we can create value in these uncertain times. Fortunately, we have a very able moderator who is going to guide us through the next discussion. Now, many of you know him through his many, many professional achievements in the world of finance. But I would also like to let you know that you have to get your hands on his books. and give them to your friends for the Christmas season. Out of the Goby and money games is a great way to get started. And once you've got those done, you'll be ready just in time for his new book coming out in early 2023. We will be hot down to Bookazine to get our copy of Money Machine, a trailblazing American venture in China. So with that, I will welcome our moderator to the stage. He is the executive chairman of PAG. Please welcome Wei Jinshan. Thank you for joining us. Yes, please. Yes, sir. You are right here in chair number 1 as our moderator. We'd like to welcome our panelists in rapid fire. We have William E. Conway Jr., who is the co-founder, the interim CEO, and the co-chairman of Carlyle. There we go. He is going to be followed by Luke Ellis, who is the CEO at Man Group. Thank you very much, Mr. Ellis, for joining us. We would like to welcome Ben Wei, who is the group head for Macquarie Asset Management. And thank you. And Jim Zelter, the co-president of Apollo Asset Management. And with that, thank you. Mr. Shan, the floor is yours. Thank you.
Thank you very much. Good morning, everyone. Good morning, ladies and gentlemen. Congratulations, Paul, Eddie, Laura, for this very successful summit so far. And it's so delightful to see Hong Kong opening up like what we're doing right now. And today, I'm extremely honored to moderate this very distinguished panel of leaders in the alternative asset management industry. And these are all veteran investors, and they have been through many economic cycles. In the past day or so, we have heard many people talking about challenges facing the global economy. Top on everybody's list is high inflation rate. And then we talk about geopolitical risks. Now in the United States, inflation rate is now more than 8%. And we know that the interest rate is about 4%, coming up from 25 basis points about this time of last year. I think it is probably just a matter of time that the economy in the United States will slow down sharply. And we know that this year, the economic growth rate for the country is suspected to be about 0.5%. So we know there are challenges over there. However, the labor market remains quite tight. Unemployment rate is 3.5%. So it's questionable where the US economy is going to be next year. Now, if you look at Europe, the situation is much worse. Inflation rate now is double digit, exceeding 11%. Interest rate is still quite low at 0.5%. And growth rate this year, I think, is probably at best 1% or slightly more than 1%. So indeed, inflation is a major challenge in the developed world. Central banks will keep raising interest rates, which may not be high enough to tame the inflation rate, but may be high enough to push the economies into a recession. So we worry about it. But here we are in Asia. And if you look at Asia, you talk about the high inflation rate, you ask the question where the high inflation rate is. Just look at China, right? Where the inflation rate, the last I saw, was 2.8%. It's very tame. Where's the interest rates? Well, interest rates last year was 5%, and this year is 3.65%. So the monetary policy, as Governor Yi Gang yesterday pointed out, is accommodative, very different from the Western world. However, the Chinese economy is sharply slowing down, as we know. The target for economic growth rate was 5.5%. But in the first 3 quarters, it registered about 3%, I would think barely. And it's still not possible to tell what the full year number will be. So we have challenges in that particular economy. Then you look at Japan. Where is the inflation rate? Well, Japan's inflation rate is 2.6%. So it's very low, and Japan is still trying to reflate its economy. Whereas the interest rate in Japan is minus 10 basis points. Right? It's still negative interest rate. And the Japanese yen has dropped more than 30% in the past 18 months. We're all dollar-denominated investors. So if you think that Asia is attractive, well, you have to watch about your currencies, because the depreciation in currencies will have major impact on our returns. Now, I mentioned these 4 economic regions: the United States, the EU, China, and Japan, because 4 of them represent about 2/3 of the world economy. For the United States, it's about 24% of the world economy. For China, it's about 18%. For EU, about 17%. Japan is relatively small at 5%, but Japan is very significant for the Asian economy. So looking at this just 4 major economic bodies in the world, one question that comes to mind, and that is, at this very moment, not tomorrow, not next year, not 2 years from now, at this very moment, which market of the 4 is the most attractive? Where would you bet your money? We know all the challenges. We know all the difficulties all around the world. So where would you bet your money? And may I start with Bill?
You sure you don't want to start with one of these other?
The reason I start from you is because you are in the buyout space. You're in private equity buyout space. You know, I could start with Ben. He's in real assets. I know he's probably now going to be very keen on investing in real estate in China.
Well, you know, thank you for the introduction, and it's great to be here back in Hong Kong. I think that first of all, I have to give a couple of caveats, which is that if you were to have asked any of us a year or 2 ago what we thought things were going to be like a year or 2 later, that is now, we all would have been wrong. And so any prediction people make should be understood in that light. Secondly, our analysis shows that there's very little correlation between the performance of the economy and the performance of equity markets. And of course, that's kind of counterintuitive to everybody who thinks, you know, a strong market, strong economy, the market's going to go up. That's the place where I want to invest. It just has not been the case, frankly. Having said that, while it's always tough, frankly, for somebody with a dollar brain and brought up and educated in America to bet against America, I think for me, the market I probably prefer the most today would be Japan. And part of that is because I do have a dollar brain, and I see that the yen has gone from 105 to 150 in a matter of months, and everything's on sale in Japan for people who have dollars. And I think that it's something to take advantage of. Maybe it'll go to 160 or 170, I don't know, but I think that there are going to be very attractive transactions done then. You know, you asked about now. I think if you were to think about a little longer, you'd think of other places perhaps to invest, but you didn't ask me that.
Well, you can ask yourself.
Well, I do. And in addition, remember, private equity is kind of different than other businesses, yes, because we count on our limited partners to provide the money that we raise from them. And so I have 800 investment professionals around the world in all different kinds of asset classes and geographies. And their job is to find deals to do. But a private equity fund is invested over a period of 3 or 4 or 5 years. It's not invested all right away. And so I think a couple of years from now, Europe will be on sale. because it's so horrible there and likely to get worse that I'd probably think that would be an attractive market, but not yet, too soon.
So you suggest that Japan is a good place to place your bet today. Remember that. But Japanese yen is very weak. How do you deal with the currency risk over there?
Well, generally, we hedge our equity position to the dollar. I don't know that I'd do that necessarily today, although I'm not a professional currency hedger, and I like to make money on the performance of our businesses as opposed to the performance of the currencies. But I think that the currency is likely to be weak as long as the Japanese economy and the people running it are focused on trying to increase inflation and going to keep their interest rates negative. And they seem committed to that policy. And what balances those policies is the currency. And the currency's had to weaken to compensate for that. And one would say maybe that isn't going to change anytime soon. The currency will continue to weaken. So I probably would hedge the equity position and hope to make a significant gain on which I'd leave unhedged.
I think the good thing about Japan is that the currency is infinitely hedgeable because the Japanese interest rate is so low. And hedging cost is a function of interest rate differentials between the Japanese yen and the US dollars. And now with Japanese interest rate being negative, people will pay you to bet against yen. So you get a carry, positive carry, by hedging against Japanese yen. And therefore, Japan is cheap, is hedgeable.
Well, and I might add, and obviously the other panelists know a lot more about some of this than I do, that another advantage in investing in private equity in Japan is that you can borrow money so cheaply.
Yes.
The rates there are TIBOR, which is the rough equivalent of LIBOR or SOFR, at 0, and plus 1.5% or 2%. So it's just cheap to borrow, and the leverage you can put on the transactions inflates the equity returns as well.
It's free money, it's good leverage. But look, you invest in public market. Man Group is a leading asset manager by investing in the public market. And Bill just mentioned in private equity, you can keep an investment for 3-5 years or even longer. You can ride through the rough patches like what we're facing today. But in public market, you mark the market on a daily basis. So what's your pick?
So I would say trying to pick one thing today is a bad answer to the current investment problem. So we're in a world where inflation has got out in some countries. We have a very different economic situation in China, as you mentioned. We can come back to Japan. We have dispersion around the globe. And in a world of dispersion, in a world of economic uncertainty, picking one thing and sticking with it is not the right answer to investing a portfolio. For investors, the last 10 years has been, frankly, as easy a world as you'll ever see. You just had to buy something, frankly, as much of anything as you could, as much leverage as you could. Everything went up. So it was a very easy world to be an institutional investor. That world's gone. We're in a new paradigm, which I suspect will last years rather than months. And in the new world, you need to be active in terms of your asset allocation. So you can buy companies and hold them for 10 years and transform them, and the private equity world can work very well. But if you're investing in public markets, thinking there is one simple asset allocation, in today's world, I would say is wrong. This year, clearly being short the interest rates, particularly US, has been a fantastic thing. Being long the dollar has been a great thing. Being short equities has been a great thing. There's been some big currency moves. The yen has been a fantastic move, but you also have to look at what's happening to price changes over time. So the interesting thing, last night, the Fed, honestly, I don't know how anybody could have been surprised that Powell was hawkish after raising 75 basis points. He's got to be until you have some sense inflation is coming down. But the market was surprised. But the interesting thing is what you saw was a big sell-off in equities and not very much of a move in the dollar, not very much of a move in interest rates. It gives you a sense that, the long dollar trade that's been, not against the Hong Kong, of course, I would say, by the way, anybody who bets against pegs that's a dumb way to try and make money. They all remember the one time that they made money, so if you happen to be the right way around on Swiss franc against euro, when it broke, great, but it's a terrible way to try and make money over time. You remember the one time it worked and you forget the 20 years it hasn't worked, or even longer here. So we don't do that one. You'll be pleased to know. But look, there are some currencies in the region where being long the dollar and short those currencies has been a fantastic move all year. But you can sense that trade's getting tired. And so maybe that was what Bill was suggesting in the question of whether to hedge. So we run a very active style. So, right today, yeah, I'm still long the dollar and short bonds and very happy with it. But do I think I'll have the same position by the end of the year? No, probably not.
So you don't think that any particular market or the four markets I just mentioned is the most attractive? You diversify geographically. Do you care to tell this audience how you are diversified geographically? How you have allocated your capital
sure.
among the four that I have just mentioned?
Yeah, look, I think that so we're believer in maximum diversification unless you have knowledge, right? And so there are some things that one can have real confidence in and some things not. I think there is nothing worse than being the European equity strategist. There's a very nice guy who's a friend at Goldman who every Monday has to write, I guess he does it on a Sunday, a note that says, this is why now is the moment to buy European equities. And he's been doing it for 10 years and it's not been the moment yet. And got to say, it doesn't feel the moment yet. I would agree from an equity market point of view that actually Japan is about the most attractive. I think if you were the central bank, there was a lot of conversation yesterday about the challenges different central bankers face. I would say for many it's a very clear story, but it's just whether they're willing to go through the pain to do what they need to do. In Japan, it's a very difficult story because they've had 30 years of deflation, right? The deflationary things are so embedded in Japan, and they have no wage inflation. Now, the reason the US has got to keep raising rates is you've got 7% plus wage inflation with a target of 2% inflation. You've got to get unemployment up. You've got to get wage inflation down. That's the only way to get unemployment. Japan has a different problem. They have for 30 years had zero wage inflation, and you can't get sustainable inflation up to 2% without some wage inflation. And they only have a once a year wage round. Japan likes to do things differently. That's the sort of, whatever the joy and the annoyance of Japan. They have their own way, they do it their way. And essentially all wages in the country are set in March and April. And so the central bank is stuck in a place where they have to keep the stimulatory position until we get through the wage round in the hope that there will be wage inflation, at which point they have to then get out of a position which is horrible, right? Because if the yen has been a big move and when they let go of 10-year JGBs, they're not going from 25 basis points to 50 basis points, right? When they let go, it's going to go a very long way. And you can see that in you only have to go out to 15-year JGBs that are 1.5% now, and you could see how far the market wants to move. So that they're holding on to a very tightened coil, which I would say that would be the least attractive job to be the central banker. And by the way, it's available if anybody wants to apply, because Kuroda finishes in March and someone's got to take on the challenge.
I agree. I think Japan is in a bind because if you look at the United States, the government debt is about $32 trillion. So 1% increase is equivalent to about $322 or $320 billion. That's a big number, $320 billion from 1% increase in the interest rate for the US government. But in the United States, federal government debt is only about 100% of GDP. And in Japan, it's about 260% of GDP, the highest ever in the world. Think about a 1% increase in
yes, but most
interest
of it's
rate
not
for Japan.
real debt. Most of it's owned by, it's either mostly owned by the Ministry of Finance and the Bank of Japan, or then GPIF, which is another version of the same thing. So
there's no question
you have
about
to
it.
look at external debt to look at the debt you worry about.
Right. Well, there's enough holding of government bonds by foreigners for the Japanese yen bonds. But in any case, let's go to Jim. You are very much active in the credit markets. And, but Apollo, I understand, is a diversified alternative asset manager. So you're in private equity, you're in buyouts, you're in credits, you're in everything. So from your point of view, going back to my earlier question, which market is the most attractive?
Well, I'll say a few things. I have a long shopping list. You're right, at Apollo, we oversee about $550 billion of a variety of assets, really private equity, credit, and yield. But, I think unabashedly the most interesting opportunity right now is U.S. credit. Certainly we are, and yesterday's panel did a great job, James Gorman, about summarizing where we are. I was an econ major in college. I don't need to go through the backdrop. I would add one thing, though. In the U.S., since the financial crisis, the backdrop of how the financial system works has changed dramatically. The advent of private credit from institutions, sovereign funds, folks like us, it's a large part of the market right now. So the lack of confidence has created a vacuum. And right now, specifically, you can do a few things in credit. You can buy low-dollar investment-grade credit and have convexity the first time in 15 years. And I would argue over the next 12 to 18 months, mid-double-digit returns, 12 to 15% on that. You can be the provider of credit in large quality buyouts that Bill is doing or the folks at Blackstone are doing. On the Emerson financing yesterday, you can arguably make 10 to 12% top of the capital structure, 20% LTV. The third thing you can do is because of the overhang in the U.S. banks right now, which is around $100 billion of commitments they've made, contrast that to $500 billion in 08-09, they are not making new commitments. At the same time, companies need to borrow money. Royal Caribbean, Caribbean Cruise Lines, they're coming into the market right now paying you 8.5%, 9%, 10%, top of the capital structure, 2 or 3 times multiples debt to valuation on a company that has a tremendous equity cushion underneath you. So there's a variety of activities in credit in the U.S. I can also talk about equity secondaries. People talk about the denominator effect. Very interesting business. And Bill and I did compare notes. I'm also a big believer in Japan private equity. So I think if you ask me point blank right now, U.S. credit, private credit, investment grade discount paper, and a variety of other, I don't want to say rescue, but being able to work with the banks as they are not as fluid and as flush as they are. I contrast that to what's going on in this region of the globe. Obviously, the strength of the HKMA and the banking system is extraordinary here. And the markets are not broadly developed such that these avenues and cracks don't exist for folks like us to operate. But this is an amazingly interesting time. It's going to be a cloudy storm. It's going to last, as Bill said, who knows? We're very poor at predicting. We're very good at preparing. But the fact is, we were lamenting a year ago about making 4 and 5%, and I can't predict the future, but if I'm making these high single digits, low double digits, and I'm getting current cash pay today, I feel very comfortable that my downside is protected and I'm going to do very well over time. And this is the opportunity set right now. We are unabashedly very busy. We're unabashedly putting a lot of money to work. And the great irony is all of this, and I know both sides of the equation since we're in it, the great time to invest in private equity is periods like this where there is uncertainty and there's unfortunately not a lot of financing. Same argument with real estate opportunity funds. And so the irony is, as much equity has been raised, the fact is there's not a lot of financing for those transactions. So price levels will come down, but it will be an amazing vintage, 23, 24. These, I believe, will be great vintages, especially in the US and Europe in due course.
In Europe as well?
I think it's going to be a bit later. I mean, certainly there's a lot to do right now in the US. You know, we have a very large business in Europe that buys European non-performing assets from the banks. I believe they're going to go through a period of time like Asia did in the late 90s, either Japan or other Korea, other places that had to get their banking system in better shape. You know, the collective ROE on European banks in the last decade has been sub 5%. That has to be dealt with over the next 3 to 5 years. So again, back to your specific question, US credit, a lot of sub-strategies, a lot of great partners in the room that are doing it with us, but unabashedly love that asset class. Equity secondaries, and because of what's going on with the denominator effect, and also, you know, I'm happy to talk about distressed and Chinese NPLs and many other things, but to your pointed specific question, that's where I'm an unabashed bull.
You know, I'm not quite sure if everybody understands what denominator effect means in private equity. See, our institutional investors, that is limited partners of private equity firms, would allocate capital among or between, let's say, public equity and private equity. Let's say if their rule is they allocate 80% to public market and 20% to the private market. In today's market conditions, the public market has dropped quite significantly. Then they look at their portfolio, all of a sudden the public market has shrunk from 80% to, let's say, 70% or 60%. Then their private equity book has expanded from, let's say, 20% to 30%, even 40%. All of a sudden, they're out of whack, and they will have to reallocate. And that's the so-called denominator effect, because the public market value has dropped. And therefore, they will have to reallocate by selling in the secondary market their private equity positions. Sorry, I have...
No, you did a great job. And I think the point that I really want to make here is we're all... a lot of economic prognostication, which is very important, but I would really urge investors to be student of how the markets really work. And what I mean then by that is how companies finance, and we've been in this decade plus of, you know, the advancement in the equity markets of technology, ETFs, which create market structure challenges. And if you are a thoughtful investor, understanding that dynamic and using periods right now of uncertainty to your potential advantage. You use the luxury of your liquidity or the long duration of your capital to be providing capital in periods of vacuums right now. I think there's a few big lessons, and I'm just going to go off script for a moment. Certainly what is perceived or what has been perceived as safe, you know, long-dated, you know, UK governments that have gone from 102 to 38 this past 9 months, that liquidity that people perceive they needed is unnecessary. And so thinking about this market structure and how you asset allocate and how you invest, I think is a critical point to remember in these periods of uncertainty.
Thank you. May I turn to Ben, who is head of Macquarie's Real Assets Management, a big investor in real assets, real estate, infrastructure. So we have just talked about you know, some specific markets are particularly challenging, but what's your pick?
Thank you, Shan. And first, let me say, Finance Secretary and Eddie, thank you so much for the last few days. As someone who was a long-term resident of Hong Kong, the excitement around the city, the excitement in our office to see people that are here talking about these sorts of issues has been great. So I think everyone's thankful, and it certainly feels like we're back. So thank you to you. I've sat across the table from Shan in other circumstances, and he sets good homework. So I have thought about this, Shan. I know you don't always think I've thought about your questions in other deal meetings and other things, but I have certainly thought about it today. I get the Japan trade, particularly if you're looking at it from a private equity point of view. I think if you're looking at it from a real assets point of view, we've spent 20 years trying to find good deployment opportunities in Japan, and we're still trying. So that's a market. While I get the currency trade, and we'd love to have a bigger position there. Unfortunately, that's a little bit more challenging for the many things that we do around real assets. I'd say, the most exciting market right today is the US. And I think about things like the Inflation Reduction Act, which I'm not sure will reduce inflation, but it has created a lot of investment opportunities and a lot of positivity, I think, around real assets in the US. And I think that's also matched by the fact that we are seeing a lot of innovation in the US beyond just traditional renewables. As economies, as states transition and think about what's next, both in terms of adapting their current energy mix, but also retooling their cities, and then thinking about the sort of renewables 2.0 around things like hydrogen and storage and other things. So I think if you're a US dollar investor today and you're thinking about where can you deploy capital in a market that's incredibly competitive and innovative, I think it would be the US. And I think if you have a look at what's happening, say, specifically in infrastructure, last year was, for the top 100 infrastructure managers, the biggest fundraising year on record. And so I think we're starting to see infrastructure somewhat come out of the shadow of private equity, which has really been, I think for us, been the standard bearer asset class around the world for the sorts of things we do, because they're very similar. And we're now starting to see a real need for private infrastructure capital around the world, and that's exciting. One, because we've got really more great managers providing more choice to clients. It creates more competition in the market, but most importantly, for communities around the world, it's capitalizing capital to address the most important issues that we're facing, which is either rebuilding nations after COVID, where it's helping with energy security, energy transition, and addressing really big challenges like how we actually get to net zero by 2050. And I think at the moment the US is leading on that, and for other reasons in terms of, I suppose, just access and currency, that makes a really attractive market. The second market, which no one's talked about today, but the second, I think, most exciting infrastructure market in the world is clearly China. And again, the scale of opportunity in China, the very positive policies around renewable energy, but also the investment around things like hydrogen and scaling up hydrogen and reducing the cost is very real in China, unlike it is in many other markets. And I think what is often lost is, we all read certain media outlets, and there's still a debate going on in a lot of those media outlets about, will hydrogen ever be investable? Yet, just to the north of us, people are building scale hydrogen businesses together. They've passed that Rubicon. And so what's exciting, I think, about markets like China is that a lot of real asset classes, which in some other markets are still considered to be sort of at their early stages, are starting to become scale. And that creates a whole new set of sectors. And I think it's akin to sort of to data centers. In private equity funds, in infrastructure funds, no one really had much exposure to data centers 10 years ago. If anyone's been pitched a private equity fund or a infrastructure fund in the last couple of years, front and center is data centers, because it's become a scale asset class, and so that's exciting. And so while I think digital infrastructure still offers a lot of opportunities, particularly in places like the US and China, I think it's interesting that we're starting to see a whole range of new asset classes kind of become scale, and that will present opportunities, particularly for investors who are not so worried or stressed about yield today. And there are a lot of investors who have a real need to manage for yield right today and have an issue around liquidity. But those who can allocate parts of their portfolio, allowing for the denominator effect to longer term assets over 5 to 10 years, I think they're the asset classes and the markets that are particularly exciting.
I agree with you. I think infrastructure is a wide space. Perhaps around the world, there are opportunities in the United States, in China, talking about energy, clean energy, talking about data center, using clean energy. PAG itself is a big investor in data center business. We also control the largest producer of industrial gases in China, producing oxygen, nitrogen, hydrogen, and so forth. Noble gases, the prices went up several times this year, and those are the gases for the semiconductor industry. But when we took this company private in Hong Kong, it used to be listed on Hong Kong Stock Exchange in 2017. It didn't have any new energy business, clean energy business at all. And this is a company which generated $1 billion EBITDA cash flow last year, so it's a very big company. Today, clean energy, including hydrogen, represents 25% of their revenue. So it's growing up in China very, very quickly. And this company has 40% market share in China. That underscores your point. But you're talking about infrastructure. You're talking about data centers. You're talking about clean energy. And another side of real assets investments is real estate. Commercial real estate, residential real estate. I don't assume you think that real estate in the United States and China are also very attractive in this environment, especially in the United States where interest rates are rising?
So in answer to your question, and I think Jim touched on before, real estate is a small part of what we do, and we primarily do opportunistic real estate. So it's really finding thematics around the world where there's not enough inventory and where there's capital required and addressing that need, as opposed to having sort of core funds of residential or property real estate around the world. But I would agree with you. I do think real estate in certain markets, particularly if you're looking at long-term core portfolios, is difficult to invest in at the moment, particularly where we find ourselves from a funding point of view. And so I don't think that's particularly attractive. But there are other aspects to real assets that I do think provide attractiveness outside of real estate. And I think one of those is, say, agriculture. And agriculture as a real asset class, I think, is incredibly exciting. And there are a few reasons for that. And I think the first one is, food is not particularly correlated to GDP. People need to eat, and there is actually a scarcity of high-quality food supplies to the world. So while the world continues to want more almonds, more raspberries, more blueberries, more Wagyu beef, more red wine, more Australian lobsters. Wants more of that. There's actually less providers of it and less arable land that's providing it. So I think, first of all, that's a really interesting asset class as people think about if I want to have an allocation to a real asset, but real estate doesn't make sense today, which I think we can all understand the reasons for. There are other asset classes that I think are really interesting. And I think the second thing about agriculture is also the fact that technology has really changed what you can do from an agricultural point of view. I think a little bit, Shan, like your point about the gas businesses that you own in China and we own in other markets around the world like Korea, where if you think about a farm today versus 10 years ago, the technology's changed significantly. And so not only can you use that land to produce proteins or to produce vegetables and other products, you can also use that land for carbon abatement. You can also use that for renewable energy, particularly with the increased improvements in transmission technology. So what was a farm with, say, one revenue stream, you've now been able to pivot and create 3 or 4 revenue streams. And the important thing about those revenue streams is you're actually having an impact often from a net zero point of view. And so, we're farming much more efficiently. We're able to use that land much better than ever before. And that's also in a lot of communities around the world, whether it be in the US, whether it be in South America, China, or Australia. That's also a great story in terms of economic inclusion. Because often where those farms are positioned, there haven't been a lot of jobs, and we're able to create more jobs using that land than ever before, and that's actually helping communities, rural communities, rebuild themselves. And so there is, from an impact investing point of view, in the sense of wanting to get great returns for clients from real assets, but also have a positive impact for everyone in your community. There are lots of assets that are now presenting that just we didn't have the technology or the wherewithal 5, 10, 15 years ago.
Very good point. Let me change gear a little bit and come back to Bill. PAG is also in the private equity business, and I have observed over the years a great difference in how we do business here in Asia and how business is conducted in the United States. In Western markets, financing typically is very much available for acquisition business, for buyouts, going back to Jim's point. So in the United States, for example, and in Europe, when you do a buyout, you typically can borrow 6 times or even 7 times EBITDA or cash flow of the targeted company to do your acquisition. So you combine your equity capital with a lot of borrowing to do acquisition. And therefore, when the interest rate is very low, buyout activity is very high because, like in Japan, money is free and you can lever up your equity capital to do very large acquisitions. Now, Jim just talked about providing private credit capital to buyout firms at double-digit interest rate, or high single-digit or low double-digit interest rate. In view of that, in view of the fact that senior financing is becoming increasingly scarce, banks are withholding credit, do you think that buyout activities in this kind of market, in the Western market, will slow down? Now compare it with in Asia. For example, we manage about $50 billion, which of course is dwarfed by the AUM that all of you manage. But in China, where we also have rather large exposure, the average leverage, EBITDA multiple, in terms of leverage, we have is just 2 times, because financing is not so much available. So you generate returns in a country like China by tagging along with economic growth. You can still generate private equity type of returns without leverage in China because the economic growth rate is rather high. In the Western market, where the growth rate is typically 2 to 3%, without leverage, you wouldn't be able to generate 20, 30% returns for private equity investment. Now in Japan, without leverage, you won't be able to generate 20% returns, right, at all. So now the interest rates are rising, and credit is much less available. How does that affect the buyout market? How does that affect private equity investments?
Well, in the third quarter, globally, M&A activity was down 50%. And a lot of that had to do with the fact that there's much less availability of debt capital. I do think that private debt, as opposed to private equity is really the present and the future. It's going to continue to grow as share as private equity grows as its share of the equity. I think private debt will grow as its share of the debt. You're right about the amount of debt that's available in Asia, or that is commonly used anyway, and it's much less here than it is in America and in Europe. I'd like to make a comment, though, if I could, about China that might be somewhat relevant, I think, for everybody in the audience, which is a statement of the obvious, which is that when I first started coming to Hong Kong, or even before then, the GNP of China was $350 billion. And I think this year...
Which year was that?
Huh?
Which year?
1990. And here in 2021 or 2022, the GNP of China is going to be $17 or $18 trillion.
Yes.
And so the people running China for the last 30 years, they were doing a lot of things right. And when one thinks about the future, do you think China's going to be smaller tomorrow than it is today? No. And I don't think people should. You may argue, well, the people running China now will do it different than the people did then or whatever, but it's a spectacular track record that they built, and I think it's very hard to bet against China when it comes to investing generally, particularly for people with a long view. But returning to your question about debt, I think the thing for people to think about is, well, if there's less debt available, or if the debt costs a lot more, what will that do to equity returns? And the answer is, all other things being equal, they'll go down. But of course, all other things aren't equal. And when we look at our results in various kind of debt markets, you'd think there'd be a much bigger difference in terms of the returns from the different environments, but there isn't. There is a difference in the amount of transactions done. Because right now, or in the next year or so, that's going to be a spectacular time to invest in some of the markets that Jim was speaking about, particularly. The problem is there'll be a lot less transactions done. The sellers will want to, as best they can, hang on to their businesses because they know it used to be worth something and they hope it'll be worth that again, and they're going to fight for that. And if they can only hang on for X year period of time, ultimately you'll get there. And so the deal transaction volume, I believe, will fall generally everywhere, and particularly in the developed markets here for a while. And eventually, sellers and buyers kind of get enough price discovery, and they get back in sync on what is a business really worth. But it does take a while for that to happen.
Yes. Yeah, and I would add to Bill's point, we're not in the market share game. We're not on the sell side at Goldman or Morgan. We want to do good investments. So with my private equity hat on, there will be 6-9 months of price discovery, and there will be that private family, third-generation company in Japan or in the US that wants to sell. And yes, it might have been worth X, but you know what? Let's not wait around. We can invest it and make more money. So, again, to the point, these financing markets, there's a dislocation. It's going to cost more money. But eventually, prices will probably come down because the returns, we're going to be disciplined. Good investors are disciplined right now, but the cost of it, I've rarely seen a buyout that made a lot of sense at 7% financing and didn't make any sense at 9%. You're talking about the wrong company. So I think there's going to be a period of a lot lower volume, but very interesting transactions that if you can put them together, you'll do well.
And Shannon, if I can just add one point, I totally agree with what Jim's saying. I think the other thing we're also about to see is, I think we've made the point on the panel already today, is that over the last 10 years, there's been a rise of a whole range of managers who have only ever invested into a market where you had easy money and you had expanding multiples. But if you've been doing this for a long time and you're on vintage 6 or vintage 8, you've seen this before. So you've got more experience and probably a bit of scar tissue of knowing when to say no and sit on the sidelines and when to say yes. And I think this will be the time as people start to choose managers and continue to allocate capital, we'll see an unmasking of what's a good manager and what's a great manager with the right investment culture. Because it's not when things are easy that stands out, it's when things are tough. And particularly in a world, as Jim says, where there will be more scarce opportunities, it will come down to who's willing to pay a certain price, but it'll also come down to your network and the ability that if people want to do business with you because they can trust you to do business because you can get banked and the like. And so I think that'll be that's a really interesting next phase of investing, which I agree will probably last for, not 1 year, but, for multiple years. But I think that will mean that we will have some shakeout as well in the asset management industry.
The current economic conditions, market conditions, very much remind me of 1997 Asian financial crisis. Many of us remember that. And 2008, so-called global financial crisis. Yesterday, Mark Carney used the term the Atlantic financial crisis, referring to the so-called 2008 financial crisis. He was right, because that financial crisis very much affected Western countries, the United States and Europe. Many banks failed, but it didn't really affect Asia at all. In 1997, 150 banks failed in Korea alone. And in Japan, a number of banks failed. Like Long-Term Credit Bank, Nippon Credit Bank, all failed. Throughout Asia, there were many bank failures. But in 2008 and 2009, to my knowledge, there was no bank failure in Asia at all. So the 2008 crisis didn't really affect Asia as much as it did Western countries. In that particular year, China's GDP, 2008, went up 9.6%. The next year, 9.2%. Whereas for the United States, in 2009, GDP came down 2.6%. So we went through a number of economic crises in the past. And from my personal experiences, we made a lot of money in those downturns, economic crisis. My second book, Money Games, talks about the acquisition of a major bank in Japan. And my third book is going to talk about a major acquisition of a bank, controlling acquisition of a bank in China. So I remember that the founder of TPG, David Bonderman, once said to me that if a deal is structured right, this type of market conditions is probably the best time to buy. It seems to me, Jim, from what you have just said, you agree?
I completely concur. I mean, I think that it's very easy to get caught up, and I do have. There's an underlying confidence that inflation will be tamed, whether that's 23, whether that's 24. I think the demographics around the globe, it will be tamed. And so how are you pricing it? How are you protecting yourself? But I think the great investment platforms, the great LPs, the great sovereign funds, if they look back at these periods of dislocation, I know I was experienced before coming to Apollo, and many of the post-Korea, Japan, those restructurings, they were incredible opportunities to buy franchises that were literally once in a generation.
Correct.
Now, I don't suspect you're going to see that in the U.S. I think the U.S., the greatest president of all time for private equity is covenant-light debt. The worst president of all time for distressed investors is covenant-light debt. And while defaults will, and I know because I'm in both businesses, but the reality is defaults will be higher the next couple of years. But I think, again, this lack of certainty, this lack of confidence, this is when you want to be putting money in the ground. We don't celebrate on buying companies. We celebrate when we sell them. And so, it's truly an amazing time.
What about public
markets? I know there's this sort of thing that private markets are great and public markets are, but maybe the truth is there's price discovery. Hang on. But maybe there's a thing of there's price discovery in public markets, and they're telling you something, and there's sort of one of the solutions to the denominator effect is maybe people in private markets to mark things to where they're now funding things rather than where they used to do them, and then you'd suddenly find the denominator effect went away. I think the bigger picture is people have got used to the idea that sort of economic problems are short, maybe sharp, but they go away quickly, that buying dips has been the answer. And Jim's right that there will be a moment where there are opportunities to buy things super cheap. But inflation in the US is only going to go away if they enter a significant recession. There's a real question of whether the Fed has got the sort of stomach to drive it this time. But today we have twice as many job openings as we have unemployed people. The point where you get rid of inflation, you've got to get rid of wage inflation. You get rid of wage inflation by having twice as many people looking for jobs as there are available jobs. Now, putting that in context, that maths would get you to something that looks like 10% unemployment. Right now, I don't think that central banks really have the stomach for that now, but we're either going to have significantly higher inflation remaining, which creates significant volatility in asset prices. And you look at the 70s, and over a 10-year period, there was a zero return to a real portfolio, zero real return to a portfolio, bonds and equities. It was a lot worse in bonds and better in equities. You get real defaults, and out of that, we will create a distress cycle at some point. But I think, we should recognize to deal with the economic problems requires some real pain, and sitting on a portfolio invested the way it's been for the last 10 years is going to be painful for it.
And if I could just support
The person who owned that UK sovereign debt piece, the 1.5s of 62, they know about pain going from 101 to 38. What you're saying is, until we have capitulation, I agree. Listen, if you're an investor right now, capitulation's even a more enjoyable market. And yes, it's going to be a nasty fight to tame inflation. No doubt about it. I know that we have 30 to 40 private companies. I get a survey every month. And the reality is CEOs are in a slowdown mode. They're stopping hiring. They're stopping expansion. They're stopping digital ads. It's not going to be a 10-year process to slay inflation. It will happen in the next 24 to 36 months. It will happen. The world happens much sooner. I was around in 94. I was around in 87. What's happened in the last 6 months, 4 months really, in the bond market, the bond vigilantes are so far ahead of the monetary authorities in the West. And that will happen by the time we recognize that we are in a recession. The market will have anticipated that, and bond levels will be lower in the U.S.
And to agree with both of these guys on one point there, and it may sound like they're disagreeing, but one of the things that really is happening is the raising of interest rates yesterday at 3/4 of a point in the United States, in the last 3 meetings at the exact same amount. It's easy for Jay Powell and the Fed to increase interest rates when unemployment is 3%. Anybody in America who wants a job can get a job. If we get to unemployment of 6%, it isn't going to be easy for them to fight the inflation fight. I agree that we're going to fight. I think eventually victory will be declared not at 2%, but at some level higher than that. I don't know what it'll be.
Yeah, and also, like you asked earlier about commercial real estate, residential real estate. Residential real estate is actually fascinating right now. If you're a home builder, you are not selling a home in the U.S. Literally, you're not selling a home. I know, we own one. Rates have gone on a 30-year mortgage from 2.5% to 7%. On the other side of the equation, though, we have a deficit of 3.5 million homes in the U.S. A lot of equity in homes right now. Home prices are not going to go up 8, 10, 12%. They're going to go down. Do they go down enough to create a 07, 08 housing crisis? I doubt it. Maybe in some secular markets, but not in many. So my point is, I think that we have to remember the U.S. economy is so service-driven that the impact of higher rates, it's not like the 25% the industrial side of the business or the manufacturing side of the business. Rates are very quick in impact on that side. Having rates impact on the transmission mechanism takes longer in a consumer-driven economy. But it will. I mean, interesting. Airlines and hospitality doing very well. Home builders, used cars, autos, really proverbially hitting the wall.
I think the challenge today is somewhat different from 1997 Asian financial crisis and 2008 economic and financial crisis, in that in 1997, the market and the economies quickly bottomed out. And we knew that. It couldn't get any worse. In 1997, going back to Korea, the stock market dropped 49%. The currency dropped 65.9%. So combined, in US dollar terms, the market dropped 85% in just one single year. On October 23rd, 1997, the Hang Seng Index here in Hong Kong dropped 16% in one day. So we knew that the market was bottoming out very, very quickly, and therefore it was somewhat easy to conclude that it was time to be contrarian. It's time to buy. Today, I think the challenge is that we know the inflation is high. We know that central banks are raising interest rates, but interest rates are still negative in real terms, right? Inflation rate is 8%, interest rate is 4%, so you still have negative 4% real interest rate. And chances are the interest rates are not going to be high enough to put inflation rate down, to tame the inflation. But chances are the interest rates will be high enough to push the economy into a severe slowdown or even recession. And I think in the United States, it is a very interesting situation where the labor market is very tight. But in Europe, I think a recession is almost a certainty. So there is still a long way to go where the bottom will be found. And I think that's a challenge for us to figure out whether or not this is a good buying opportunity. But in the time remaining, I would like to give the audience opportunity to ask all these brilliant minds about whatever you have on mind.
He's talking about us, I think.
I'm looking at the 1 minute 27 on the clock.
I'm looking for the brilliant minds.
We need brilliant questions.
A short question.
Well, if there are no questions, that means you have addressed all the questions that everybody has in mind anyhow. I would like to thank this distinguished panel for your wisdom and for sharing your thoughts and your experiences. And this is extremely illuminating, and we thank you very much. Again, we thank HKMA and Hong Kong Stock Exchange for holding this great event. We're very happy to be here, which signals that Hong Kong is open and we're ready to do business. Thank you very much. Thank you. Thank you.
Thank you very much to Mr. Wei-Jin Shan for his able guidance for our panel. Gentlemen, our photographers are standing by. They would love to take your picture if they have that opportunity. Yep, don't leave the stage. Jim, thank you. If you can just hold in there, we're going to get all of you to take a photo. Fantastic. There we go. Ladies and gentlemen, we will be taking a short break, but it is only a short one. Listen for my voice to call you back. Due to health concerns, we are not going to be serving coffee, but there is bottled water to keep you hydrated during the break. Keep an ear out, and we will be calling you back for our next panel very shortly. Thank you very much. Very good. And big smiles, gentlemen. There we go. Wei-Jin Shan, that's a big smile. That's what I like to see.